Thank you, Brantley. I am, can anybody hear me? I am very pleased and honored to be here to introduce John Heyman. He's one of our own here at the Terry College of Business. He is the founder and partner of Actuate Partners. Actuate Partners is an investment firm focused on the technology sector, which John founded after the sale of Radiant Systems to NCR. John served as CEO of Radiant Systems, which he led through the early growth stage, a public offering, and its evolution to become a $400 million business during his 17-year tenure at the helm. When it was sold by Johnny and his crew for $1.3 billion, Radiant Systems was the leading U.S. provider of technology solutions to the retail and hospitality industry. John serves on several boards, MEDSEEK, a provider of technology to the healthcare industry, where he's the chairman. Inmar Corporation, a technology company which operates intelligent commerce networks. He's on the advisory council. And most important to us, the Terry College of Business Dean's Advisory Council, where he's been a member since 2010. Additionally, he is co-founder of Sifted, a new technology that allows restaurants and their supply chain partners to conduct business more efficiently. John is a graduate of Harvard Business School. Prior to that, he attained an accounting degree at the Terry College of Business. He lives in Atlanta with his wife, Erin. He has 3 sons, Bentley, Tyler, and Charlie. I could stop here, but I must say that Johnny was largely responsible for Holy Innocents Episcopal School and his sons and my sons winning the 2000 AA State Baseball Championship, which I know is probably one of his most proud moments. He has many. He is a pioneer in the true sense of the word, and I take great pleasure in introducing Johnny Heyman.
Thanks, Robert. That's the shortest amount of time I've ever heard you speak about anything. I had this nightmare of a presentation in 2000. I was at an investor conference. It was about 4 times this size, and I got up to the podium, and the presentation did not work. And so I had to wing it with a bunch of investors in the room, many of whom were shareholders, and that was a very frightening moment. And I came here today with a presentation, and I thought it'd be given to a bunch of strangers, and I see so many friendly faces in the crowd who've known me since high school and college, and kids I've coached in baseball over the years, and I've got this presentation, and you guys actually know the truth. So it's just as scary, and but it's good to be here today, and I really thank you guys for coming. And those of you who know me a long time know it's more now about being lucky as opposed to being good. My wife is not here. She would say hello to many of the friendly faces, but I told her last night, I said, well, I'm speaking tomorrow morning. I've got to be there at 7. Do you want to come? And she said, do I want to wake up early in the morning to come see you speak at 7 o'clock? And I don't think so. I said, well, there's a lot of people coming, and they're paying $30 to hear me speak. And then she didn't believe me. She said, you're not really speaking. Nobody's going to pay to listen to you speak. And then I woke up really early this morning, which I don't do as much anymore, and I put on a suit and a tie, which I never do anymore. And she goes, you're really speaking, aren't you? And I said, I'm really speaking. But thanks for getting up this morning, and thanks for being here. And hopefully what I can do is share some of our success at Radiant. I'm giving way too much credit for the company. There were 1,500 or so people that made Radiant a really special place. And some of them are here today, and they're the ones who should get all the credit. I was just lucky to be part of it. But what I'd like to do today is give you just a feel of kind of how we grew from basically nothing to $400 million, and probably every startup's dream, sold for well over $1 billion. And hopefully you guys can learn something from our successes, but hopefully you'll learn more from some of the mistakes and failures we had along the way. When you start off at zero and you sell for $1.3 billion, it'd be nice to think about it being all this one nice linear progression. But along the way, we were worth zero. Then we were worth $100 million when we went public. At a point in time in the dot-com bubble, we were worth over $2 billion. We dropped back down to being worth less than $100 million at a point in time. And we just kind of kept our nose to the grindstone, and were a little too stubborn, I guess, to give up. And really good things happened for us. So I'll tell you that story. I don't know if all you guys know what Radiant Systems did, but largely I would say every single one of you probably interacts with our systems every single day. We sold solutions to the movie theater industry, the restaurant industry, sports stadiums, specialty retailers, gas stations. We had, when we sold the company, well over 100,000 sites using our products. So if you were at any of these types of venues, you probably were interacting in our systems, or people who were serving you were interacting with our systems. And they ranged from the point-of-sale cash register systems, which was our initial product, to really innovative front-end systems. So if you're ordering sandwiches or more movie tickets online, whether it's through your mobile phone or at your desktop, all the way to very sophisticated back-office systems that help people like Chick-fil-A manage their food costs and labor, et cetera. That was what Radiant Systems did. So I know we took a lot of pride in seeing our systems out there. And in the software world, it was one thing to sell systems. It was another thing to get systems working. And we took a lot of pride in doing that. But let me get into the presentation. The early years. I'm an investor primarily now, and oftentimes people come to me with a business idea, and I just ask some few very basic questions. What's the problem you're trying to solve? How big's the market for your product? How many people are interested in buying it? What's your team look like? Because if you don't have a problem you're trying to solve, if you don't have a great team and your market's not big enough, what you're doing probably is not going to matter that much. So we bounced around for quite some time at Radiant. For those of you who are in startup endeavors, sometimes you put this business plan together on an Excel spreadsheet, and you've got all these drivers, and you know, here's where I'm going to be in 6 months, and here's where I'm going to be in a year and 2 years. And those of us who've been through it know it usually takes a little longer than the spreadsheet says it's going to take. And so you better be willing to really work your butt off while you're doing it. And the commitment we had during this time was to hire just amazing people. And we finally found an industry after 5 years of writing, basically doing custom code projects for a few different retailers. We finally found an industry, the convenience store industry, that had a real problem. There were thousands of sites out there. Operators had no way to automate those sites. The employees in a convenience store, they're open 7 days a week, 24 hours a day. The typical employee has about a 6-week tenure. You can't train people to use software. They're not educated. Even the managers of the sites aren't educated. And so we came up with a touchscreen system back when nobody was using touchscreens. Today, everybody's used to touching something. Back then, people weren't used to touching screens on computers. So we came up with the first touchscreen system in retail. We actually went to work in the stores. We figured out the different problems around cash management, inventory control, et cetera. We automated that. We didn't have a sales force, but fortunately, there were some big customers out there interested in what we were doing, and we solved that problem for them. And through a lot of hard work, blood, sweat, and tears, we started growing the company. And the company grew from a very small company in the early to mid-'90s to 1996, we did 15 or 16 million dollars, and it started to feel real. The company started to feel real for us, and we started to set our sights on bigger and better opportunities. Lessons here: find a problem, make sure your market's big enough, and go to war with great people. So in 2016, the company grew. 2016, and that's still a couple of years away. In 1996, we doubled the size of the company again. We came up with another innovative product in the movie theater industry. If any of you have ever gone to the movies and gone, instead of to the traditional box office, you went to a little kiosk outside that box office, or you started calling and getting your tickets through a phone system. Those were our systems at work. And by the way, when they weren't working, it was because the theater manager wouldn't put paper in the ticket dispenser. The software always worked. But we more than doubled the size of the company in 1996, and we were able to go public. And this was really important for the company because we had never attracted a nickel of venture capital. People wanted to invest in us, but we kept saying no. And the reason we said no is we saw money back then as a commodity. We don't see money as a commodity today as investors, but back then as operators, we saw money as a commodity. So we didn't take any venture capital, and that was really important, as I'll talk about later on, because it let us keep control of the company during some pretty dark days. We also, during that time, because we didn't have venture capital, we gave 30% of the company to our employees. Every single person inside Radiant was a shareholder when we went public. And the day we went public, there were probably 30 or so millionaires in the company. And there were only a couple hundred people, so that was a pretty cool thing. Went public in early 1997. It gave the company, for the first time, real capital. It also gave us kind of a new boss, which was the public equity markets. And we were always answerable mostly to ourselves, but all of a sudden we had to answer to 200 shareholders. And they wanted to know things like, what were your quarterly numbers going to be? And so forecasting became a real issue for us. We were, frankly, more lucky than good. We got our numbers right for probably the first 6 to 8 quarters as a public company. The stock kept doing better and better, one of the top 10 performing IPOs in 1997. And Radiant was a really exciting place to work, got a lot of great publicity, articles in the Wall Street Journal, all sorts of awards, a lot of fun. Robert asked me to talk a little bit about what it was like managing Wall Street. I think a lot of people have this opinion that Wall Street's very short-term focused. We hear a lot about that in the press, and I don't think that's the case. I think the facts are Wall Street's actually very long-term focused. They want to own stocks in great companies that are going to grow. The facts of the matter are you have portfolio managers who, on average, probably own a couple of hundred stocks in their portfolio. They can't possibly understand the companies that they invest in, each and every one of them. And so what happens is they place an enormous amount of trust in the CEO and the CFO and the company. And if you miss your numbers, they're done with you because they don't have time to understand. We may be able to understand why we missed the numbers, and it's a very rational explanation, but they don't. And they just throw you in jail for a year or so until you start showing that you deserve their trust again. So I actually think Wall Street, for the most part, is very long-term focused. We were a public company from 1997 to 2011 when we sold the company, and every single time I went out to meet an investor, they would bring out this notebook. And they had this notebook, and they'd go back to things we said in 1997 and 2001 and 2008, and they have long memories, and it's all about building trust and credibility. This scorecard for us created a lot of excitement. I mean, employees who owned stock could look at the stock price and see it going up and could see their net worths going up. And that was a very powerful thing inside the company and created a lot of energy. And it was also something that, I'll tell you right now, we didn't manage that well. I hear a lot of CEOs talk about creating value with all their employees and how much money their company is going to be worth one day. And most people who work at companies actually don't care. And one of our problems, I think, was we created too much focus on our stock price. We got a little caught up in it, and I'll talk about that some more later. We went through the late 90s. This was the gut check time. So the company kept growing. We went public. We were doing about 40 million. We kept growing. Y2K came along. I don't know who was selling software in Y2K. So one of the great times to sell software, because everybody's systems out there were broken and they were going to not work on January 1st, 2000. So it didn't matter what your software did as long as it would work on January 1st, 2000 when people came into their company. And so we rode that wave. The company kept growing. In 1999, we had a record year, did about $120 million. This was also the dot-com times. And there were companies out there that were much smaller than Radiant that were going public with billion-dollar-plus valuations. All of their names either began with a little I or a little e. It was I this or E that, and they'd get a billion-dollar valuation. And we kind of wanted some of that. And we started, I think, taking our eye off the ball. AOL came to us and said, gosh, we'd like to. AOL was a very relevant company back then. There was a war between AOL and Microsoft about who was going to own the internet. AOL came to us and they invested about, Gus, by the way, was our auditor back then. So Gus, check me on all my facts, please, because I know you've had to do it before. But AOL came to us and they said, hey, we'd like to invest in your company. So after a weekend, literally a long weekend up in Washington, we struck a deal for them to invest in our company. We announced it Monday morning. Our stock price went from $15 to $30 that day. It's a pretty good day to be at Radiant. Stock price doubled based on a press release. Microsoft saw that. We were working with Microsoft too and said, gosh, we'd like to invest in you guys. We have this business idea that we could work on together. So Microsoft said, let's go do a joint venture. And we said, okay, sounds interesting. A press release with Microsoft might be something the public would really like to see. So Microsoft made an investment in Radiant, or announced an investment in Radiant. We actually ended up never doing it. But the stock price went from $30 that day. Anybody want to take a guess what the stock price ended the day at on a Microsoft investment? $130. We called a company meeting afterwards. We announced the press release, and we just kind of watched the aftermarket trading in the company, and it was just, lots of excitement. So record year, stock price went from $15 to $130. We saw the internet as a whole new way to deploy software, a whole new platform. We announced a new product strategy that we thought would take $10 million in a year to build. It ended up taking $50 million in about 4 years to build. But how do you think we were feeling then? $130 stock price. I was scared. I really was scared. It was kind of a, I remember my neighbor came over to my house and he gave me a big hug that week and thanked me because he was able to buy a lake house with the money he had made, this true story, on Radiant's stock. But we weren't selling our stock. And we started looking at the business, and these press releases and the artificial buying that was happening in Y2K were really covering up some very real issues in the company. The markets we were serving were pretty small. We didn't have a way to grow the markets, and if you start becoming the market share leader, that can be dangerous if you're not growing your market because you run out of room to grow. We had a product set that couldn't serve the small business person, which was the biggest part of the market. We had a stock price that I knew in every single mathematical calculation I could ever do would never be justified. And we had a lot of shareholders and employees who at that price had very large expectations. And I knew it wasn't real. So it was actually a very scary time. It was a great time to go to cocktail parties if you were at Radiant, because people were really happy. They bought the stock low and it was trading really high. Later on, by the way, it wasn't so fun to go to cocktail parties. But we had to really look hard at ourselves. I think we'd become arrogant. I think we had this notion that anything that we did would turn to gold. And the same things that made us so successful about staying so close to our markets and our customers had started to bring us down. We weren't paying attention to those things. We were paying attention to things like press releases. And what we were doing was just not sustainable. So we had to face the facts as a company. This is where it was important to not have taken venture capital into the business, because we were still in control of the company. By and large, there were a few people who owned enough stock to control the business. We had a really good team in place, and we kind of looked at each other in the mirrors, and we said, let's fix this thing. And in terms of expectation setting, we went to our board. This was a very popular thing, and we said, you can't have any expectations of us for the next year. I don't know who serves on boards, but that's not a really popular thing for the management team to say. We went to the stock market, and we'd been a darling of the stock market. And we told the stock market that, you know, those conference calls we have with you every single quarter, we're not going to have those anymore. We're not going to talk about our company. We'll issue press releases and tell you how much money we made, or in this case, we were losing. But we're going to fix our business, and you should have no expectations of us until we tell you otherwise. The stock price went from $130 a share to $4.50 a share. So pretty dark days. And if you're in the technology business, you know you can't just fix things like that. It takes time to think about your strategy, and then you think it's going to take time to build some more software, and then it always takes longer to build that software. But we faced the facts. We did a lot of things inside the company. A number of us worked without pay for a year. Every single leader in the company took a significant pay cut. We did a lot of things, frankly, that I regret. We froze salaries. We took away 401k plans. We stopped giving stock to employees. And these were dark days, and it was a tough time to be at Radiant Systems. But we started to get people refocused on what's important in the company. Anybody in here work for a startup? So have you guys been through a pivot yet? So the pivot in the startup world is something that's really romantic now. And the pivot is basically you have a strategy and you start to execute it, and then, oops, the strategy was wrong, let's pivot. Well, the pivot's really popular and kind of romantic right now, and it's hard to do when you're a public company. So we took a step back. We said, what is the market? Back to the old days. What's our market? What can we be best at? And let's figure that out, and let's start doing more of those things, and let's stop doing the things that aren't important to us and to our customers. We'd lost a lot of customer trust back then because we sold a lot of software, and when you sell a lot of software, customers expect you to keep working on those products. And if you're in a software company or you use software, you know you'd like to see the vendor improve that product. And what did we do? We were off building this new $50 million product. Well, our customers had bet their careers on buying our old products, and we were kind of running away from them. So we had to re-earn our customers' trust. We convened, spent about 6 months and convened at Chateau Elan up the road, and this was in the 2003 timeframe, and we reset the strategy, the vision, and the values of our company. And I remember meeting with some of the top people at Chick-fil-A, who was a great client of ours until they told us they were going to fire us in 2002, 2003, because we were not meeting their expectations. And it took us a while to earn their trust. And I went to the people at Chick-fil-A, and I know Dan spoke to this group a few months ago, but we laid out a new vision statement. I wanted to test it with them, and the vision statement was about re-earning our customers' trust, and it was about to be a remarkable company, I said, to buy from, work for, and invest in. And the guys at Chick-fil-A said, well, you know, that's really interesting that you put customers first, and we like our customers to think about, you know, their first. But the way we really do it is we put our people first. And it was like a big slap in the face to me. I said, of course, we're a technology company. We don't really sell anything that you can see. We're selling technology. Of course it starts with the people. Those are our warehouses. Those are our trucks. Those are our manufacturing plants. So it was a big slap in the face. We rewrote the vision to be a remarkable company, first to work for, then to buy from, and finally to invest in. And that was our mantra. And it took a while to earn our people and our customers' trust, but we were able to do so. We identified this kind of new blue ocean, this small and medium-sized business segment of hundreds of thousands of restaurants and retailers. We started building products that we could sell to them. We started building a channel of business partners that would sell to them for us because we couldn't afford to hire all those salespeople and service staff. We built a new organization that was people and customer-centered. We created a new business model that I know Gus appreciated, which instead of large, lumpy license sales, I mean, it's great when you sell a $10 million license fee deal, but it's really hard to go do that every single quarter. And so we created this, for those of you in the software business, a SaaS model. For those of you not in the software business, we started really renting our products as opposed to selling them to our customers. So we started to build up a much more stable operating model. We started to make a lot more money, and we kind of lived by a new mantra, which was promise what you're going to deliver and then deliver what you promise, and setting that type of culture in the company. And the company grew from $100 million to close to $400 million when we sold it. Really never missed a beat except for in 2008, which we actually shrunk a little bit, but the most important part of our business actually still grew 25% in the worst retail economy of all time. And it was an incredible success story, and I was grateful to be part of it. We went from having about a 7% share in our industries to 24% share. We went from customers buying one product to many products. We went from hundreds of people to thousands of people, and the stock price gradually improved. And wherever it was at a point in time, instead of it being $130 and being scared about what it was really worth, I always felt it was worth more than what the public was trading it at. And that was a really good time to be the CEO of Radiant. So the strategy worked, and it actually worked too well, because NCR came calling, a few other companies had called, and we really never set out to sell the company. It was just never something we ever. Today, if you talk to venture capitalists or private equity, they always want to ask you about the exit. Who are you going to sell the company to? We never thought about that. We just wanted to build a great company. NCR called in 2010 and said, hey, you're the most strategically important company in our space. We think it'd be a great deal for our company to buy you, and here's the price. And I basically said, no, thank you. This is all a matter of public record, by the way. It has to be. About a year later, the CEO called me back, said, can you meet me in New York? And I met him in New York. He said, well, we've raised our price. And I said, well, that's great, but our company's grown, and that price won't work. And over a few weeks, he kept raising the price. And we were a public company, and while we didn't really want to sell, when somebody's offering you a 60% premium to your stock price, you have to look at it and say, is this the right thing for the company? So it was clearly the right thing for our shareholders. And then we looked at our company, and NCR had a brand and global distribution, and they needed our business to fix their own. All of our success over the years really came at the expense of people like NCR and IBM. And we agreed to sell the company. And I miss it dearly. It was a great place, but it was a very successful ride. And probably my one piece of advice would be, you know, don't think about the exit. Build a great company and ride the down periods. And then if you're at some point in time interested in an exit, somebody will be very interested in your company. But if you think about maximizing it just for sale, I don't think that's a prudent way to go. You got to be a little bit more lucky to win in that scenario. We sold the company. One of the things I'm really proud about today is we were a $400 million company. NCR's about a $7 billion company. And every single business unit, I believe, at NCR that's responsible for revenues and profit is run by somebody who worked at Radiant Systems. And I just take a lot of pride in the fact that our leadership team has been that important to remaking that company. Let me leave you with a top 10 list. Sometimes this is the only thing I show at these presentations is my top 10 list is just make sure you're fixing a problem. There's so much noise out there in the market and companies doing so many things with so many different ideas. And, you know, at the heart of it, make sure you're fixing a problem. Make sure that a consumer or a business is going to find value in what you're doing. Otherwise, it's not going to matter over the long term. Do it better than anybody else. We spread ourselves too thin. We thought we could do anything, and we stopped being good at any of it. And when we got refocused, we started to grow a lot faster. And at the core of that was we asked ourselves, what could we do better than anybody else in the world? And for us, it was to serve the small business person with technology and tools that nobody else could. Profits matter. Profits matter. I see so many startups that, you know, they're going to monetize this or monetize that, and they're just going to spend money on R&D and building out the sales force. They're going to disrupt industries. They have no idea how they're going to make money. And investors oftentimes pour money into that. But unless you can create something that's profitable over long term, you're not going to create any value. Growth's got to be sustainable. We got caught up in artificial things that were growing our company and growing our stock price, and we weren't thinking about longer term. What are the problems we're fixing? How big are the markets? Are we taking care of our customers, and will they buy more for us? Do we have the right people inside the company? Think about those things and think about sustaining your growth. I think I've spoken enough about this. It's all about the people. I mean, we had an amazing group of people. I started my career at Arthur Andersen, which is a sad story. I mean, it was, I think, one of the greatest professional service firms that ever existed. And it came to a very quick death because of making some very bad mistakes and not owning up to them. And I always wanted to recreate that atmosphere that we had at Andersen. Super smart, energetic people who were willing to work hard and take care of their customers. And we created that at Radiant. Make your customers raving fans. I think that was a watershed moment for us. I don't know if you guys have ever read a book. People ask me a lot of times, what books do I read? I read a book in 2003 or 4 called The Ultimate Question. I don't know if any of you've read it. It's about a customer sat methodology it's involved with something called the Net Promoter Score. But the concept is create raving fans in your customer base. And if you can do that, they will sell your products for you. And that is the truth in our market. A lot of companies want references. Well, it wasn't about references for us. We wanted raving fans. When we went into a sale, we wouldn't say, here's our reference list. We said, here's our customer list. Call any of them. And that's how one of the key ways we sold. And I encourage everybody to embrace this philosophy. Try a new pair of eyeglasses. Since I left Radiant, I was wearing these eyeglasses as CEO of the company that was based on the business we had at the time. Since I've left, gosh, I know these industries so well, and these other people have come up with ideas in the industry. And if you just take a step back from your business, or maybe from your job that you've got, just take a step back and think about what you're doing and what your company's doing, kind of with a new pair of eyeglasses on. And I think you'll see some innovation and some potential to create real value in what you're doing. I know it's been a lot of fun for me to do that at Actuate and invest in these other companies. We live in a transparent world, more so now than during some of the struggles we had at Radiant, but our leadership team was put to the test a few different times, and people want honest communication. You can't hide from your people. You can't hide from your customers. Be open, be transparent with them, and they'll help you improve your business. And if you don't, you'll lose their trust. And there are all sorts of tools now as an employer, Glassdoor. If you're a restaurant, there's Yelp. But if you don't do a good job taking care of your people, your customers, people are going to find out about it pretty quickly. So be transparent, own up to what your issues are, be committed to improving it, and you'll build incredible trust. And then when you have problems, people will stick with you through the problems. Being a leader is an obligation. I've seen some other organizations go through the issues we've gone through, and the CEO or the management team continues to get their perks, or maybe they get a new really big grant of stock, or they get a raise from their board when nobody else is getting a raise. Being a leader is an obligation. If you're going to ask your people to sacrifice, you better be willing to do it yourself. I know during some of the tough times when we made sacrifices, our people really appreciated it. And we never had reserved parking spaces at Radiant for the longest time. If you started work out of college, you sat in the same cube that I did. When we started buying companies, we had to change that a little bit, but for the longest time, whether you were an executive or a new employee, you built your own desk, you sat in the same cube as everybody else. It was a meritocracy. It wasn't about what your title was. And finally, this is the fun one. I'm sorry, Connor. Connor works for me and went to Tech. And by the way, Tech is an amazing school, and Radiant would not have existed without Georgia Tech, so I'll just tell you that. I mean, we had hundreds of the brightest software engineers in the world working that we just couldn't have gotten. But the old joke about what's the Georgia Tech alumni called the Georgia alumni, and the answer is boss. Somehow, some way, I ended up in that seat. But no, it was a great run, and I really feel myself more lucky than good. Grateful to have been a part of it, and I guess I'll take any questions now.
If you got a question, please wait for the microphone since this is being recorded.
Yes. Oh, wait for the microphone.
When did you sell your business? I'm sorry. When did you start working with NCR as a customer? After your reformation of a company, or were you there an early on customer?
Well, NCR was never a customer, to be clear. They were a competitor. The giants in the industry were NCR and IBM, and they decided that they wanted to sell more hardware, and at the time got out of the software business, which was a giant mistake on both of their parts. And it allowed companies like us to come into existence. So over time, what they found was it was very hard to sell their hardware and services without software, which is why you started to see them buy software companies again. The first one was Radiant. So
the fact that it became a Atlanta headquartered company, was that coincidental to you being purchased by them?
Well, they always had their retail manufacturing organization here in Atlanta. So I don't think so. And most of their executives actually still live in New York as opposed to Atlanta. They got a very big commitment to Georgia, but the headquarters still is really in New York.
Hey, John, thanks.
One of the Radiant team members.
Yeah, former Radiant Systems employee, and while I was there, Radiant Systems acquired a number of businesses. And I was wondering if you could talk about the decision-making process around those acquisitions, which I know, like Aloha, was extremely successful for Radiant Systems. Yeah.
Thanks. Yeah, I think once we got our foundation strong, meaning we kind of level set the strategy, we had a model where we could make money, we said, you know, the way for us to grow the company is to do one of a couple of things. Either A, add more value to every customer we served, which selfishly meant we'd also build more products that we could sell them and increase our revenues, or expand our markets. And so we had this kind of build, buy, or partner strategy. And if something was really strategic, we felt like we had to own it. If something wasn't strategic, we felt like we could partner with it and use our distribution channel to sell other people's products. So, you know, we made a series of acquisitions. There were probably 4 or 5 important acquisitions along the way. Aloha was kind of a bet the company acquisition. It was done in the 2003, 2004 timeframe, and that company, we had a product strategy to reach the small and medium-sized business, but we didn't have a sales force or a service entity to do it. So we were trying to build that ourselves, and we said, why try to build it when there's this company called Aloha that is already there? So we bought Aloha and started feeding more and more products into that channel. So that was something we felt like we needed to own. But we were very focused on, you know, were there small acquisitions that could accelerate our strategy and help grow the business faster. And it was, I think, a pretty successful component of what we were doing. Robert.
You've commented on how your company, certainly after 2000, became an employee-oriented company. Can you comment on the interview process and the characteristics of the person that your company sought during that period of time until it was sold?
Yeah, the interview process, it was not a one-day process in the company, and it was a pretty brutal process for people to go through, actually. So we had a set of values inside the company. There were 4. See if I get them right, Clint. Still, teams of winners. You had to, you know, you had to be someone who had a track record of achievement and be willing to work as a team. Working to bring ideas to action, which was not just about the innovation itself, but actually implementing that innovation and creating value out of it. The third was the fourth was respect and honor. Teams of winners, ideas to action, customers for life. It didn't matter what our contract said with our customers, that when somebody made a decision to go with Radiant Systems products, there was an implicit handshake there, and our job was to make them more successful than they ever dreamed of with our products. So teams of winners, bringing ideas to action to create customers for life, all while respecting and honoring each other. And so there was typically 2 tracks in an interview process. One was somebody was, you know, 4 people would have one of those values, and they were testing that person with the interviews to see if they adhere to our value system as a company. And there, you know, you couldn't get away with, you know, fluffy answers in that. So people were well trained in how to ask questions. And then the other was just functional competency. So developers would interview developers. And one thing a software developer does not want to do is work with a software developer who's not up to snuff. Somebody who's in a professional service function understands that the team's built on A players. So I would say there was a track around functional competencies. There was a track around values. For a long time in the early years, either myself or one of my partners would interview every single person before they got a job. Once the company got beyond 200 employees, that was really hard to do. But we'd interview every person, whether they were an accounting clerk, a service technician, or a VP level person. And I think that did kind of set a tone in terms of expectations of people. Eventually, we had to let go of that process because we had 13 offices around the world. And, you know, as you grow, you just need to be able to let go of those processes and make sure they're not dependent on you or somebody else in the organization. There's a process. So we had a great HR organization. I think most companies underinvest in HR. We tried to invest heavily in it. We had, you know, some great EVPs of HR who guided this. And it didn't stop there. We went through, once you were an employee, you kind of continued to go through an interview process, and I every single year went through a 360 process myself that was completely anonymous, where I would get feedback from my direct reports and others in the company, and that is a pretty brutal process. So, so if you haven't done it, you know, embrace it, but embrace it with thick skin. And so we you know, it was just this continual improvement attitude we had in the company around our people, whether they're coming in the door or growing them.
Maybe one more question.
Charles, we were fraternity brothers at Georgia, so don't ask me about any incidents there.
No stories about Athens. Talk a little bit about what you're doing today at Actuate and maybe some of the more interesting things you've been looking at that you can speak about publicly.
Sure. I can speak about any of it now because I'm not a public company CEO. So Actuate, we formed Actuate. One of the founders of Radiant, myself, and our CFO formed Actuate after we sold the company. And we're investing primarily our own capital, but we have some co-investors as well. And the thesis behind Actuate is we understand the software industry. We understand specific aspects of the software industry: retail, restaurant, other hospitality venues, healthcare really well. We understand SaaS, the cloud, mobile. We understand data and analytics really well. And so what we've been trying to do is marry our capital with our industry expertise and provide growth companies who feel like they need capital and guidance. And I would emphasize guidance because we're ex-operators, so we have strong opinions after we invest in companies. We're not silent partners. So those are the kind of companies that we're interested in. I think that our general thesis is, you know, I think about, well, I haven't spoken, but I used to cite my mother, who passed away earlier this year, but I used to cite my mother as somebody who would never imagine using software. Now, she was using an iPhone and she was using lots of apps, so what she didn't realize was she was actually using software. So the adoption by consumers and businesses of software is creating all kinds of new opportunities to create, I think, networks. It's creating so much more data out there in business to analyze and make decisions on, and start to where things were automating transactions historically. You can also now start thinking about technology as really automating knowledge, if you will. And you know, instead of retailers having to go through reports and assessments about what's selling and what's not selling, you can actually construct a system that will tell you what to order, when, and what not to order, and cut the price in literally minutes on a real-time basis. And so the things that are happening in mobile and with the cloud and software and data and analytics are fascinating. And technology seems to go through these cycles where there gets to be a point where you say, gosh, it's mature. How much more can we grow it? You're with Salesforce, you know. I mean, you start to say, how much more can I run? And then things happen, and you say, gosh, there's a whole new world out there. And when we sold Radiant, there's this whole new world: social media, the cloud, data analytics, mobility, consumer adoption. And there's just so many great ideas out there to invest in. And, you know, we've been picking and choosing pretty carefully. We've made 4 or 5 investments, and so far, happy with all of them. Thank you very much.
John, thank you very much for your presentation today. Congratulations on all your success, in particular #1 on your top 10 list. As a memento for the occasion today, we'd like to present you with this glass sculpture, which was done by Laura Eby. And thank you very much again for being with us today.
Thank you.